Hello, and welcome to Lay of the Land, a podcast from global law firm K&L Gates, where we discuss the latest thinking, new developments, and best practices in today's real estate industry. We hope you enjoy this discussion. Please reach out to suggest topics or guests, or with questions about real estate law.
Thank you for joining us for this podcast. We are covering global office asset trends, a look at 2023 and beyond. I have my colleagues with me, Jennifer McCosker from our Sydney office, Christian Major from London, Tobias Gries from our Germany office, and Anna Amprimo from Milan. Post-pandemic, with some level of remote work being here to stay, globally, the real estate asset industry is tracking an unprecedented reassessment in this class. To paraphrase Mark Twain, have the rumors of the death of office been greatly exaggerated, or are office assets hanging on with a new focus led by a flight to quality by end users? A rising rate environment makes navigating this new normal even more challenging. In this podcast, we're going to talk about the trends that are being seen in the global marketplace for office assets in response to these conditions. So again, globally, there has been a bit of a slow road to recovery in the office market, primarily led by shifting needs from end users, with owners, investors, and lenders all reevaluating their strategies, especially taking into account interest rate and valuation concerns. European city centers do seem to be holding valuations and rents, while U.S. and Australian markets have been seeing a flight to quality with a glut of B and C class office assets that may potentially be ripe for better uses. Disruption is in effect within the office asset class on a global scale. However, ultimately, this may end up providing opportunities for willing investors. In this podcast, we are going to be talking about and highlighting trends across the U.S., Australia, and several European markets in greater detail to shed further light on how developers and investors alike are coping with the stresses in diverse urban office markets. So just to touch on the United States, there has been certainly a shift in how we work. To quote Stephen Roth, the CEO of Vornado, you can assume that Friday is dead forever and Monday is touch and go. While this may not necessarily be the case in every urban market in the U.S., it's certainly what we're seeing in Manhattan. This may, of course, be an overly pessimistic viewpoint, but again, major urban centers such as New York and Chicago are seeing some form of remote work or hybrid working and shorter in-office work weeks as a sticking trend. Again, for major cities like Chicago, New York, Dallas, Atlanta, and Los Angeles, outlying suburban areas with high and costly commute times, together with higher in-city living costs and larger numbers of jobs that may be performed remotely, are disrupting the demand for urban offices. Additionally, shifting needs in the workplace, office tenants are also looking for newer and higher quality, amenity-laden spaces. Significant office space footprints seem to be a waning trend for many major companies. In the tech space especially, we're seeing companies often looking to reduce their existing office footprint. Law firms, financial services firms, banks, and the like globally seem to be reevaluating their need for office space and reconsidering how their employees use the space that they currently have. In the U.S., in terms of owners and lenders, they're also seeing losses in valuation on prime office properties in gateway cities as tenants roll over and downsize, as existing office stock also not only becomes perhaps underutilized, but is also aging. Just a brief look at some of the trends that we've seen. The mortgage loan data analytics provider TREP has been tracking a wall of maturities in the CMBS market with a valuation of $12.7 billion US that's expected to come due between this year and the next in Manhattan alone. Out of that $12.7 billion, $7 billion of the debt is comprised of 10 office buildings in Manhattan, with 4 alone located on Park Avenue. So given the current rate environment and valuation impacts, this will certainly make refinancing difficult for equity owners. Additionally, according to a recent Colliers market report, owners and investors will really both need to navigate the changing sources of market demand, as well as demographic trends and lower occupancy rates, while facing hesitation in the capital markets. Refinancing and modification requests do need to be treated with care, taking special consideration for potential equity needs in regards to dollars allocated both for asset refurbishment, capital improvements, as well as releasing costs. We would expect to see in the current marketplace that when owners are looking to refinance, the call for potential needs for equity infusion may certainly be a reality. Furthermore, again, in the U.S. markets, Colliers is expecting over 1 billion square feet of office space to roll over before 2026. If, on average, tenants are seeking reductions between 20 and 30% of their existing space as predicted, projections suggest that may result in upwards of 300 million or more square feet that could be unoccupied as a result. Vacancy rates, together with other market conditions, are drivers in valuation reductions for office products across the board. One question in regards to upsides to the downturn: significant valuation drops, of course, may result in interest from foreign and domestic equity buyers looking for fire sale prices, depending upon their long-term hold strategies and their appetite for repositioning. Lastly, we would note also that in the U.S., we are starting to see more urban centers that are proposing plans for revitalization or potential repositioning and or conversion of underutilized office assets into other asset classes. For example, in Manhattan, Mayor Eric Adams recently unveiled the New York City's office adaptive reuse study, which focused on various recommendations to facilitate the adaptive reuse of underutilized office stock. This is similar to a program that was previously put forth in the financial district, which provided for tax incentives for conversion of office space to residential. Mayor Adams also recently put forth a plan called MCORE, which would provide similar incentives and reductions in mortgage recording tax under certain circumstances for revitalization of various office assets below 59th Street within the Midtown corridor. So these are all interesting tactics that municipalities seem to be putting forth in order to address office distress. And it really suggests that there are going to be interesting developments in the times ahead. Jen, would you like to give us a glimpse into what you're seeing in Australia?
Thank you, Heather. And interestingly, Australia is experiencing many of the same trends in the office leasing market as that seen in the United States. Sydney is generally seeing resilience in office leasing among grade A buildings. One result of the pandemic is a shift in how employers and workers seek to use their office space, designed to have a collaborative, more social environment with appealing common areas. At the start of 2023, there was a 25% increase in tenant inquiries for grade A buildings. However, many tenants are now renewing their leases and taking advantage of landlord incentives for fit out. One of the key drivers behind this is that it is increasingly difficult to lease contiguous floor space in grade A buildings due to high occupancy rates. While the grade A market is generally strong, B and C grade buildings are suffering in Australia and are not fully leased. There is evidence of a flight to quality as better quality office space has become more affordable. However, notwithstanding this trend, the elevation of rental incentives combined with lower levels of occupancy is anticipated to have a material impact on valuations. As a result, large commercial office assets across the Australian eastern seaboard are currently facing a valuation dilemma. While listed property stocks have been trading at a heavily reduced rates over the past year, the direct market is yet to see corresponding discounts applied to prices of office buildings. However, a number of key assets are expected to exchange prior to the end of the financial year in Australia. It is generally anticipated that they will exchange at a discount of 10 to 20% in comparison to 2022 valuations. Once the dust settles from these transactions, the optimistic view is that the deal rate will begin to pick up as parties adjust to the new valuation reality. There has also been discussion as to whether the conversion of underutilized office assets is a viable method to address the nation's housing shortage. Whilst this may be an attractive option, it is not one that has yet been supported by local policy in Australia. However, recent changes in local political regimes may, however, boost interest in conversion or build-to-rent schemes. This is something that many are watching quite closely in Australia. Thank you, Heather.
Thank you, Jennifer. That was very insightful, much appreciated. Christian, would you be able to also share with us the trends that you're seeing in the London city centre as well as the remainder of the United Kingdom?
Thanks, Heather. And similar to the trends that you described for the US, the office week still remains shorter and patchy in the UK. In the City of London, Mondays and Fridays in particular are effectively dead days. On Tuesdays, Wednesdays and Thursdays, greater number of workers are coming into the office and there's much more of a buzz. It feels on these days that we are not yet back to pre-COVID occupancy levels, but getting there. This impression is backed up by the statistics. The weekly average office occupancy before the pandemic was 63%. The weekly average is now half that at 31%, but it is creeping upwards. On Tuesdays, Wednesdays and Thursdays, the daily figure is now at 44%, which is 2/3 of pre-COVID occupancy. There also seems to be a growing sense that companies are seeing the value of in-person collaboration and training for the success of their businesses and the strength of their brands. And so it seems likely that the trend towards higher levels of occupancy, based around a 3-day in-office week, will continue slowly upwards. What then is the impact of this new 3-day office week on space requirements and rental values? Put simply, businesses want less space, they want better quality space, and they want more flexible space. ESG concerns are also at top of mind. Evidencing these trends, we can look to simple numbers. So far this year, 92% of take-up by tenants in London is now of prime or Class A assets. 62% of take-up of space is that which has excellent or outstanding rating for sustainability. 16% of take-up is by serviced office operators. Unlike in the US and Australia, in London there is no glut of supply. Inflation in the construction industry, both with respect to materials and labour, has led to delay in new projects coming online. While it is projected that 16 million square feet of office space is expected to come to market over the next 5 years, average annual take-up is 5 million square feet, creating a shortfall. Further, while existing tenants may be re-evaluating their space needs, demand has so far held up, and we've been seeing, for example, a good number of US tech and financial services companies continue to expand to London. As a result of these supply and demand factors, rents remain stable, with an increasing gap between prime rents, which are edging up, and secondary assets, which are edging down. Luxury Class A space in London is in the region of £105 per square foot. Prime assets will be at approximately £85 per square foot, and we can see secondary assets languishing down at £45 per square foot. What then is happening in the investment market for offices in the UK? Well, we've been seeing a massive price correction. Capital values are now 21% off their June 2022 peak, the fastest drop the market has seen since 2008. And in the span of the last 9 months, approximately £210 billion of value has been wiped off the books for UK assets. Where this fall will stop is dependent on interest rates stabilising and inflation coming down, both factors which are uncertain in the short term. It is always useful to keep a close eye on 10-year bond yields, and these are levelling off at about 3.75%. If prime real estate yields are fast on their way to 5.25%, that reflects a spread of 1.5%, which is not so far off the 30-year historic average of 2%. On this basis, UK real estate may be beginning to look like it is on track for fair value, especially for equity players. There are also some positive indications. In the first quarter of 2023, transaction volumes were double those of the last quarter of 2022, with much of the uptick attributable to renewed interest in offices by Asian buyers in particular. And in March 2023, UK real estate showed the first positive return since June 2022. Core office assets remain high on investors' wish lists. On this basis, the UK office market could turn a corner over the summer, with prices and values reaching a 25 to 30% overall decrease. In summary then, I've described three key aspects. First, a slow return to pre-COVID occupancy, at least on the basis of a 3-day week. Second, rental values are stable, with demand for small and high-quality space, at least for now, offsetting the flight from secondary. And third, the possibility that the investment markets turn a corner over the summer. The road to recovery is bound to be bumpy, but there are some reasons not to be unduly pessimistic. And with that, Heather, I'll hand back to you.
Christian, thank you for that outlook. And it is certainly good to hear that especially there's been an uptick in interest in equity investments and that you feel as though the market may yet turn a corner. So we will certainly look to see how things go with anticipation. Following Christian's summary, Tobias, can you tell us what you're seeing in the Big Seven in Germany?
Of course. Thank you, Heather. I'm happy to do that. In principle, Germany is seeing the same trends in the office transaction and leasing market as it has been reported already for the US, Australia, and UK. I may give you a very recent example, which has been in the news here in Germany today and a few days ago. One example, for instance, is the German central bank, which initially planned an extension of their letting areas of about 100,000 square meters. They have come to an agreement with the Workers' Council, and they, due to the change of home office and time available in the office, they have reduced their extension now significantly to 5,000 square meters only. I think this is a very, very good example of what happens here right now in the letting market. Another news was about the necessary refinancing, what we will face in the near future. And here Colliers is talking about equity gap of 17% for refinancing. I think these are two very impressive examples of what is going on here at the moment in the market and what has a strong influence on the almost say a hold on the transaction in the office sector. We are still facing the difference between the expectations of vendors and investors with regard to the available products and prices. In particular, developers in Germany have been reporting challenges in obtaining financing for their new developments. A number of current challenges to the office market have led to a significant downturn of turnover in the rented spaces. According to a report by JLL Germany, the office market has suffered a 30% downturn in the Big Seven, which we were asking for. So those cities like Berlin, Frankfurt, Munich, Hamburg, Cologne, Düsseldorf, and Stuttgart. The individual results, of course, differ significantly. So, for instance, we have an increase in Berlin of about 7%. It is remarkably that the lettings of smaller areas up to 800 square meters are still there in the market visible. However, when we take a look at the bigger lettings, such as above 5,000 square meters, it becomes very rare. Notwithstanding the leasing size metrics, Class A rents remain stable and are even expected to increase given the security of availability and increased desire of high-quality office products. This is shown by a vacancy rate of only approximately 5% for Class A spaces in the Big Seven. The lack of high-quality spaces in attractive locations is impacted by a number of factors here in Germany at the moment. The first and still very high challenge for developers are the high property acquisition costs of the last few years. There is a huge challenge in the reluctance from financing resources to fund new developments, coupled with rising interest rates. The unavailability of financing for projects with Russian investors. For instance, here in Berlin, there is a high-rise building project almost come to a complete stop at the moment due to problems in the financing. In addition, there is the impact of price increases and supply chain issues is still here in Germany, which cause a significant delay in construction projects. Additionally, the German office market is affected still by a significant increase of rents due to the indexation, which is caused by the inflation of last year. So we are facing here an increase of approximately 10% in rents, which is, at the current market situation, a challenge to many of the tenants. The last aspect I would like to highlight here, which is probably a little bit, specific for Germany here in Europe, at least at the moment, is beside the attempts by many investors to push ESG at the moment. The German government is pushing strongly new initiatives for the improvement of the energy saving methods in buildings and to increase the application of renewable energy. At the moment, there's a huge discussion and therefore also a significant uncertainty in the market that nobody actually know when and to which extent such new requirements to buildings, existing buildings and new buildings will be applicable. So far about the German market.
That was very insightful. And I especially find it interesting about what you are seeing in terms of the German government's goal to really push for ESG and, the move to requiring retrofitting for HVAC and other building systems for environmental concerns. I think in the U.S. market, that's something that we're going to start to see more of, especially as office stock begins to age. So thank you for sharing. Anna, would you be able to give us some insight into what you're seeing in Milan and Rome as well?
Yes, thank you, Heather. Well, it is interesting to note that despite the disruptive effects of the pandemic and the recent significant increase of the lease rent, 2022 and the first quarter of 2023 registered a quite positive trend for the office market in Italy, even above the pre-pandemic levels of 2019, that was a record-setting year. Just to give you an idea in terms of volumes and numbers, 2022 reached a take-up of about 520,000 square meters from occupiers, with an increase of 35% against 2021. Investments in the offices in terms of deals, instead, counted about 60 main transactions, which is a positive number, of course, but not comparable to the lease transactions. This is mainly the consequence of the fact that, as we are seeing in all other sectors of investments and European jurisdictions, institutional investors are now quite prudent in investments due to the uncertainty of the moment. This means that offices have been the second asset class for investments after the logistic, attracting investments in Italy for about 5 billion euros, where the most part of such investments have been carried out in Milan and just a minor and not significant part in Rome. Another data to be considered on lease transactions is that finance, consulting, and fashion are the most active sectors and together absorbed more than half of the annual take-up in terms of square meters. If it is true that the trend is positive, it is also true that the typology of the investments, especially for lease transactions, is changing. First of all, indeed, we have to consider that the prime rents are now at maximum levels, in particular in the business center of Milan, where the rent stands to 650 up to 700 euros per square meter per year. And second, but not less important, is that the smart working is becoming the reality for a lot of companies at least 1 or 2 days a week. For these main reasons, a lot of companies are trying to relocate in smaller spaces, possibly nearer to the city center. And on the other side, they seek for high quality standards, especially in terms of sustainability and technology facilities. This means that they seek for offices equipped with green certificates, such as LEED certifications, and buildings that are fully compliant with ESG policies. So what we may say is that the market demand is mainly for grade A products, which in Italy is not always so easy to provide for. Indeed, in city center locations, many ancient buildings, which may be further subject to restrictions and constraints by the relevant municipal authorities, such as cultural or historical limits, may require a significant effort in terms of costs and timing to be converted into Class A products. Also, as I was mentioned before, rent level is now significant, and also considering the high inflation of the moment, what we are experiencing is that during the negotiation phase, occupiers show a particular interest in keeping low the rent indexation and the common charges linked to their consumptions. Further, the risk of the moment in connection with the cost and timing of fit-out works make the ready-to-use office more attractive and competitive for occupiers. One last consideration that, in my opinion, worth to be done if I look at the market in Italy is that one of the main drivers of the demand for quality product is the implementation of a new work philosophy, which is focused on well-being and work-life balance. For this reason, occupiers and tenants now also seek for new concept design, where common areas and co-living spaces are becoming important to accommodate the needs of their workers. And I would say this is the main topics for office market in Italy.
Thank you very much, Anna. That was very insightful. So just circling back, based on what you've heard from our presenters today, it is fair to say that the office market across the globe is facing, new challenges coming out of the pandemic, and the road to recovery certainly may vary based on jurisdiction, as owners, developers, tenants, and lenders are all reevaluating their strategies and approaches to the office asset class. In that regards, K&L Gates' diverse real estate practice is uniquely positioned to assist clients as they approach this new normal in office for 2023 and beyond. So, we would certainly suggest that if you have further questions along these lines, you could feel free to reach out to any of the presenters today or our colleagues to talk in more detail about these matters. Thanks, everyone, for giving your time this morning. And with that, we will conclude.
Thank you for listening to this episode of Lay of the Land. To listen to past episodes and receive notices for new episodes, subscribe by searching Hub Talks, that's HUB Talks, in your favorite podcast app. Tune in next time for more real estate industry insights.